For traders that have emailed and asked, the links for the free downloads are in the description box below. Just click on the link or copy and paste and put that in your browser. The 4-step method to high performance trading and the 7-step daily routine for high performance traders create the rituals, the mindset, and the winning attitude to master the markets. Bulletproof yourself with your daily routine and your habits. Force yourself to be getting better, 1% better every single day. How good can you get, traders? Again, the free downloads, the links are down below. They're both free courses. Let's get started. G'day, traders. Stacey Burke from Stacey Burke Trading. Short video today on the major round numbers. Regardless of any instrument that you're trading, it can be currency, it can be Tesla, it could be the S&P500, it could be the NASDAQ, it could be oil, it could be crypto. It's all the same. It has a price. Several traders keep asking me, what do you mean by double zeros and 25, etc.? Where do you come up with these numbers? That's the price. It may be an index level of major quarters. We'll talk about that. It could just be the price of a currency, double zeros, the dollar levels, oil, gold, dollar levels, and 25 pip increments, quarter levels. It could be 250 pips. It can be $2.50, depending on the instrument that you are trading. The range itself, so coming back to 3-day cycles, we talk about 3 levels of rise and fall. I could be in a day 1, day 2, day 3, and I talk about the initial balance being the first 2 days of the week. Typically will establish the high and low range, and one of those extremes will tend to hold. In many cases, this first day run is our Monday runner. Day 2, Tuesday, expands the range. We now have shorts in the market. We have a low of the week in that lower 25 pip box. This market may then reverse, and we have our 3-day trade set up. Just as a basic example, but we have a quarter of volume trapped in this lower 25 pip box. That area will typically be where you will have your false breaks or trap volume. Now we can get a day 1 that goes up, and day 2 continues to go higher, and day 3 up into that 50 pip area. This is not a false break. This is a range expansion. RE, range expansion. Trader asked about a trade set up this morning on gold. The high of the week was just underneath of 75, and the market through the London session into the gap came up 3 levels of rise to 75 to lock in the high and gave a reversal trade in the US session. 3 levels of rise is not the same thing as a stop hunt or a range expansion. They are all different things. So a range expansion is when we have our high and our low of the week being expanded. Monday, Tuesday typically, and sometimes Wednesday. We can have a day 1, day 2, day 3, and our day 2 level may be the extreme. This is the peak formation high of the week, break in structure on Thursday, and a large move down on the Friday. There are all kinds of different scenarios, but when you master the 100 pip box, $1 box, 1,000 pip box, and tie that in with your high and low of the week, then these quarter levels make very important distinctions, because often the highs and lows of the day are at these number levels. So they will be around or just above or below, because we can get a peak formation off of 50 on day 1. Our high of the day is going to be slightly above there. They might come back on day 3 through that high of the week, because that was a false peak formation. Day 2 forms our low. Day 3 is our trend day. Day 4 and day 5. We can get all kinds of different scenarios. Level 3 short, and we can get a level 1 buy on day 3. So the other scenario that I talked about was understanding that if you were in the upper part of the 100 pip box, $1 box, that is a selling area. If you're down in the lower part of the box, that is a buying area. But what that does not mean is that just because something comes up to the top of the box that we sell it, because they may still be in the process of expanding the range, which is why we come back to the concept of timings, the session trades. So we have Asia, London, and New York. That's the key important to understand, is the timings. That is what sets everything up, is the timings, especially if you're trading an American index, for example. Chances are we're going to have larger setups in the US session, but we can get high of the week, low of the week opportunities on day 1, day 2 that can be in London or Asia. But if you understand the numbers, then the setups, the important thing to understand about the numbers is that when I'm focusing on my trade setups, I basically only have 4 numbers: double zeros, 25, 50, and 75. Those are my levels. So when I get into a trade, we could have a market that's come up 3 levels. It may be a trade between 75 and 50 for a move down. I have a 1 bar stop in here. It's going to be 15 to 20 pips depending on the instrument. The high is locked in, and it's going to be targeting a measured move or a range expansion. Now we have 3 types of trades essentially. We have reversal trades, we have trend trades, and we have high of the day, low of the day trades. First red day, first green day. First red day, we can get a large move that closes below the open, and we can get a 3 peaks. That can be a US session trade, it can be an Asia trade. We can get a day 1, day 2, day 3, first green day for a trend trade on the Friday. There are all different scenarios, but if you master these boxes, the rest of the setups will come together. When I look at the S&P, I use sweet spot settings. People have asked my settings. I add an extra 0 on the 15-minute charts. So again, you can set your own. If you're using TradingView, I'm not sure how you set that, but I use 250 pip boxes. So again, you'll notice the market respects the high and low of the day and the major quarter levels. We can look at any of the currency pairs. They're 100 pip boxes, Canadian dollar. So we can look at any of the pairs and we'll see the initial balance. We have a market that formed a high at 75 on Monday, Canadian dollar, a low at double zeros, and then the market proceeds to go up 4 boxes to the top of the 100 pip box for a sell high of the week opportunity in the US session, which if we zoom out, we can see that was the high of the previous week. Respecting the top of that double zero box, the market comes down 3 levels into level 1 on Thursday, day 4, for a buy low setup in the US session. This is the choppy setup day, low of the week below 50 in our lower half of the 100 pip box. So again, coming back to understanding what setups you have: high of the day, low of the day, trend trades, reversal trades. Euro, we have Labor Day, day 1, peak formation, 25 pip false break, and then the market proceeds to go up 3 levels onto day 2, putting in a high of the week, Monday, Tuesday initial balance, and a low of the week, 25 pips below the 00 box. Day 1, day 2 for a high of the day sell setup at the beginning of the Europe-London window. Day 1, day 2, day 3, low of the week. So again, trapping volume down low for the explosive trade long. Lower part of the 100 pip box, trapping volume down low, short squeeze setup. British pound, an example of the beginning of the week, trades down to 50, puts a low in place before reversing. So again, the previous Friday's high of day, you'll notice again they've put in a peak formation at 75. The market, when it moves to this level, will proceed to go 25 to 50 pips typically into that level. We see day 1, day 2, 3 pushes into the high of the week, high of the day into the 00s for a high of the day sell in the London session. Continuing that move through volume that is caught in the upper half of the box. Day 1, day 2 trades back down to the low of the week. Again, peak formation at 50. 50s are level. They trade 25 to 50 pips below there, down into the lower part of the 100 pip box, which again gives us a level underneath 25 at the beginning of the New York session for a 100 pip move back up into the short trade from 00s. Day 1, day 2, day 3, low of the week. So again, high of the week, low of the week. 100 pip box moves down another 100 pip box, trades back up inside. They trade up to the high at 50 in the gap for a high of the day trade at the beginning of the US 12 candle window back through the low of the day. So again, understanding that some of these trades will be inside, but we have a 200 pip box. Our median price is obviously 00s. They trap volume 3 levels down, 50, 25 to 0, 0 to 75 for a 50 pip explosive move up at the end of the London 12 candle window. And then a high of the day opportunity from 50 down to 75 at the high of the day on day 4. Spot crude oil, just again demonstrating the major quarter levels on oil, similar to NASDAQ, S&P. Week starts off on Monday, trades above. Again, we have a new month, day 1, day 2, day 3, third day of the month, breaks above the major round number levels for a high of the day US session. Short trade, high of the week, high of the day at major round numbers. Now, when I go to the smaller time frames on these pairs, on the 1 minute, then I add in my smaller 100 pip boxes, and you can see again in this scenario, we proceed 3 levels of rise. And what that is a 1 hour trade. We talked about this the other day. We have an inside bar in the first hour. New York opens, second hour breaks the high, closes higher, third hour opens and proceeds higher. We have a 1, 2, 3 before locking in that upper level in the top of the 100 pip box for a 100 plus pip move. 3 levels of rise and 100 pips drop. Day 1, high of the week. Day 2 gives us our first red day opportunity, a market that makes a peak formation high first and closes below the open. Closes below the open in a downward market. We have the previous day's low, which you'll notice again coincides with the major quarter level. We can use that level as a potential area now for a first red day setup. We're in a new month. Remember, day 1, day 2, day 3 of the month. Monday's the first day of the week. Peak formation high on Monday, peak formation high on Tuesday, first red day. We want to see 3 levels of rise for a massive vertical move down of over 500 pips. continuing in the U.S. session for 300 plus. Day 3, first red day short trade. Then we proceed to go below the major quarter level again, the 250 pip level 1 box, for a low of the week 100 pip plus move off the gap time at the low of the 12 candle window in London back to the high of the day, a pullback into the quarter level at the New York 12 candle window open for an explosive 100 pip move back through the high of the day. Again, major quarter levels. Market trades through, puts a low in place. They trade back into the low. They lock in the low. So for traders who keep saying, how do you know when the high or low is locked in? Study the highs and lows of the week. If you're trading inside, we need to be at the low or high of the day. This is a textbook. You're inside of the range. The market puts a low in place and goes vertical. That's the classic pump and dump for the trend trade, back following through from the original breakdown. High of the week, day 2, day 1, day 2, first day shorts in the market. That's the breakout traders. Day 2 shorts in the market, peak formation, stop hunt for the trend trade back down. And then the low of the week, taking traders into the low for the explosive short squeeze reversal. Major round numbers and quarters. Again, if we zoom out, you'll see on the indexes, these are 1,000 pip boxes. So when you get a 3 levels of rise trade, as we saw in the previous week, day 2, peak formation, a 750 pip trade for those who held on to it plus. But initially a 500 pip move from high of the day, low of the day in London, and a low-hanging fruit continuation in the U.S. session. So plenty of great opportunities, sticking to the 100 pip boxes, identifying the high and low of the week, the initial balance, and then understanding where you're at in that template for a best trade setup in the session that you're trading. So hopefully that makes sense. Major round numbers. Keep it simple, traders. Keep getting better, and may the markets go with you.